The market of PV installations, which have as business model the power purchase agreements, is a big opportunity. It's a great opportunity because it is unsubsidized solar. And we have heard now some numbers from the German market, for example, that there are projects which get refinancing within 6 years. And so one can also say that this market is good, at least for project developers and for project owners, asset owners. But there are also clouds inside. That is, for example, the cannibalization. Cannibalization is an effect which has been known for a long time. It's a simple effect. It's easy when all PV installations produce at the same time, and they do, because that's when the sun is shining. Then if you have a certain amount of PV installed, there's more electricity than needed, and the value of this electricity is decreasing. And this is a risk. There are also other risks, and it's an important topic, therefore, how to do risk sharing and risk management in these PPA projects. And we will discuss that on the panel, which we'll have in the second half of the session. And there's another topic for this panel, which is also quite relevant, Blake.
Certainly is, Mikhail. And that is 24/7 hourly accounting. Just as black and white film made way for Technicolor, annual accounting of our energy consumption will make way for hourly accounting. Provides better optics, after all. And 27, as it refers to the temporal shift, also includes a spatial model too, which means that it's a two-pronged device to drive decarbonization of the grid. And for that reason, it's worthy of our attention, Mikhail.
Yeah, definitely a relevant topic, and it also sheds another aspect, it contributes another aspect to this cannibalization issue. And we will have that on the panel later. Before we come to this risk sharing and the 24/7 hourly matching topics, we take a look to the basics. The basic of all this is electricity price, because the electricity price, the development of the electricity price, that really makes the risk. And that's why most of the big players, they have a lot of the big players in the market, they have their own market intelligence built up internally. So does Axpo, and I welcome Andy Sommer. He is head of fundamental research, fundamental analysis and modeling at Axpo Group. Hello, Andy.
Hi.
Hi.
Thank you for having me.
You will share with us your view on the midterm electricity price development, and I'm curious to see whether this golden time for solar electricity producers will continue. And then we will see back for question and answers. Go forward. Go ahead, please.
Yeah. Thank you so much. Again, thank you very much for having me. First of all, of course, also we don't have a crystal ball here. So everything that we can do from now is based on what we know as of today. And we all know how fluid the situation is right now. So everything that I'm going to show you in the next few slides can change in the next few weeks, months, years. So bear with me if I have to point that risk out, of course, please. So basically what all that is about comes against a background of already very tight energy markets, power markets across Europe. Power prices already started increasing last year, strongly into this year. Part of the reason for all of that is a very, very dry condition in terms of hydro in the Alps as well as in Spain, not as much in the Nordics this time around, but these dry conditions here mean that we do need a lot of thermal power plants to run in Europe. Another factor into that is that also French nuclear-based power generation is performing extremely poorly right now, sitting at record low levels. And also that means gas and coal burn is in very, very high demand as of now. This high demand comes against already very tight markets and very tight supply. We've seen that Russia curtailed gas supply volumes to Europe already. We are going to see the embargo and the ban on coal imports from Russia into the European Union from August onwards. So the markets are only going to get tighter and more difficult to handle. And with that, more difficulties coming up, markets also started to price in quite a bit of risk premium against all those uncertainties that come along with that Ukraine war. The European governments, the European Union, but also many corporations already announced a long list of consequences, a long list of reactions to that situation. I don't want to go through all of them in detail here, but would like to highlight uh, two topics. The one is, of course, that ban of Russian coal as well as of oil in the next coming months, plus, from the European side at least, the gradual reduction of gas imports until 2027. Maybe that goes even faster, as we see right now from the driven by the Russian side. And the other aspect here is really that the European Union, the European Commission specifically, came forward with that Repower EU package, where they stipulate an idea of even more ambitious targets in the European Union on energy efficiency as well as on renewable power and energy resources to be employed in Europe over the next few years as one reaction to that current tight thermal generation market. Within Axpo, our current base case is that renewable installations in the European Union will more than double over the next 10 years until 2030. Growth comes from offshore wind mainly, but also very significantly from the PV sector. That growth in the renewables will work its way through the generation mixes, of course. You see on the right hand charts here that the share of PV and wind and other renewable based power generation is forecast to increase quite dramatically over the next coming years. In our modeling, we see that about 3% of all the hours in 2021 were settled with a renewable energy source as a marginal source. In 2025, that will already double to 6%. And in 2030, we are likely to even reach 30%. So one third of all the hours in a year, at least in Germany, will be settled by a renewable energy resource technology. But in turn, that also means that especially gas plants will still be often needed in the years to come. So we stay relying on gas plants and gas supply also in the years to come. This in total leads us to our current price base case assumption for power prices in delivery baseload in Europe that will decrease over time in the mid and longer term. One of the factors is that significant increase of renewable energy in the mix over the next years, triggered by that EU Fit for 55 package, but also the new Repower EU package. So the amount of number, of course, brings down the overall power price average of the year, and of course will additionally weigh down on this cannibalization effect, will increase that cannibalization, and with that will reduce the captured prices for a PV operator even more. A second part in our forecast is the idea that latest from 2025 onwards, we're going to see more LNG available in the global market, and against that, less gas consumption as Europe is trying to work out right now with a recession likely to come, with also much more energy conservation efforts that we're going to have. So those power plants at the end, those gas power plants that are still needed, as I said, to balance the system, will in the longer run likely have decreasing costs as well. And that brings down power prices over time. However, three important caveats to make on that one. Of course, point one, we are relying on availability of gas supply here. And that gas supply is even getting more and more and more dependent also on factors like weather in Asia, because we need LNG supplied around the world. Other factors that might influence the gas supply into Europe as well. A second point is, of course, how quickly can that renewable expansion in Europe really get forward? Do we have trouble on getting all the components in place? So talking about that supply chain issue with China, rare earth parts and all that stuff, but also finances, planning background, the legal and bureaucracy background, all that, of course, matters here and will determine how quickly that expansion in Europe really can be. If it comes slower, then prices will stay higher for longer because we need gas for longer. But if it comes fast, then also prices can turn out indeed more quickly to the bearish side. And the last point here to make, that is market discussion as we speak right now, is those price forecasts are based on the idea of an unchanged marginal cost driven market design. But we hear many politicians around Europe discussing if that market design is still fit for purpose, if that is still the best way to go to the future. And if that market design would be changed to different measures, to different ways forward, then of course that price curve will look totally different in the future as well.
Thank you
So
very much.
risks still out there, and those risks are pretty high. And with that, I'm already at the end of my share here.
Thank you very much, Andy, for this really very interesting insight. And I'm really happy that you brought up this argument yourself, that also analysts have not a crystal ball to look into. And I mean, it's reflected very well because I remember by the experience which we had, because I think 2 years ago when Corona started, we saw this declining energy prices, and I still hear the analysts in my ears, which told me that it takes 2 or 3 years until the market will have recovered. And now we don't even have recovered, but we really see that it's going really steep up. Therefore, Andy, I would like to know from you, I mean, you showed this price curve that is really concrete and nice. Can you in some way quantify the probability? How do you handle this risk? I mean, do we have several price curves and put probability tags on those, or how do you because you have to quantify risk, because I mean Axpo is also PPA off-taker, and you have to know what to do.
Yeah, indeed, you're fully right. And as one of that handles to do so, of course, we are running different scenarios. That is basically our job every day. We're always thinking about different scenarios, different potential outcomes. We try to work in news from Germany about
and
new,
how you define the probability?
programs coming up.
How, for example, you define the probability that there will be a politically motivated price cap on the energy market? I mean, you cannot really put a probability tag on this, can't you?
No, you can't. You can't. There's no really basis to do that on a
Okay.
very solid basis. Honestly, much of that is, of course, um, gut feeling driven, experience driven by analysts, and that's why we are, um, yeah, trying to stay as close to the market as possible. I can say in Axpo we have quite a experienced team of analysts being here who try to work that out, but you're totally right. It's pretty much, especially those circumstances,
And now we
are
need
impossible to
we,
get
we have to move forward, but because you can give us a very important feed for discussion for the panel, which will start soon, almost immediately. I mean, you have already said that that cannibalization. We already see that there's a lot of renewable in the market. When I hear around, I have heard that at the moment we can see already something like 20% cannibalization effect, and will go to maybe 40 to 60%. I think that is quite easy to calculate compared to all these political decision things. And would you agree to these numbers till 2030, 40 to 60%?
Of course, it fully depends also on the setting, on that scenario that you are in, and within that scenarios, the range even for that capture and cannibalization effect will turn out very, very differently. But in a base case, in our base case scenario, like that one, numbers like you brought up don't appear too unrealistic, and I would tend to agree to them. Yeah.
Okay, thank you very, very much. That
You're
was
welcome.
Andy Sommer. He is analyst at Axpo Group, and thank you for these insights.
Thank you so much.
We've just heard a report on energy prices there, and clearly risk is high across the board. And since all market participants have to deal with this risk, we have convened a panel of experts to discuss the PPA market, how it will develop, and what project developers and asset owners can do to be successful. In the end, of course, it'll probably come down to who takes what risks. And coming to our panelists, who are joining us on the virtual stage, we have Helen Dewhurst, Sustainability Analyst for Bloomberg New Energy Finance, Marc, Principal, Energy and Infrastructure at Google, Simone Rodolfi, Head of Origination and Business Development at Axpo Italia, and of course this is a live session. Unfortunately, Roger Font, Global Head of Project Finance at Banco Sabadell, has had some technical difficulties and probably won't join us. But moving straight into it, perhaps starting with you, Helen, we just heard these reports on prices, but before we come to the risks, how different are PPA prices across the board? For instance, between Germany and Spain, are there differences, and if so, why?
Hello, thank you very much for having me today. It's a real pleasure to be here, just to start off. And yes, to answer your question, there are significant differences. So, for example, in the UK, there's currently very high. It has the highest futures pricing in Europe, and this is fed through into wind and solar pricing as well. France is also a very expensive market due to kind of a lack of supply, and also there's a prevalence of nuclear power, so there's not as many projects available, and people. Buyers are competing in a very constrained market, so prices can be upped by the suppliers. The lowest prices are found in Sweden for onshore wind, where you can get deals in the low 30s, low 30 euros per megawatt hours. Market conditions continue to flourish there in spite of the sort of the retroactive cuts to windfall profits that the Spanish government introduced last autumn. And in Sweden, you can find that's in Spain, and in Sweden you can find the lowest prices for onshore wind, which again are in the low 30s, and that's to do with the balancing costs, the low balancing costs, and the hydropower that keeps the Nord Pool prices really low.
Thank you, Helen. That was a lovely kind of run around Europe there. And so are you already seeing cannibalization risk in some of these high penetration markets?
Yes. So in the UK and Spain, they're particularly high. And this is this is due to the sort of the rapid development of renewables in both of these markets, and Germany to a large extent as well. And what's interesting about this is, we'll come on to this later. We'll be discussing annual baseload versus pay-as-produced structures, but this is fed through into significant premiums for an annual baseload structure. So we've done a price survey on this, and between the UK and Spain in particular, they've risen a lot, up to €4.5 since the second half of 2020, generally annual baseload prices, the balancing costs are higher in markets exposed to price cannibalization. So there's a direct correlation that we see here feeding through. And generally across the board, across many markets in Europe, there are universally rising balancing costs in tandem with the hedging contracts, which underpin the baseload structures, due to the high energy prices that we see since the energy price shock that started last September.
Thank you very much, Helen. That's certainly a startling rise in just 2 years. Coming to you, Simone, how are you seeing these cannibalization effects in your models? Sorry, Simone, I think you're on mute.
Oh, sorry.
There you are.
Okay. We use the same models that Andy just showed you before this intervention. But the thing is that cannibalization is, we have two problems with cannibalization. First of all, it's very difficult to estimate. It really depends on renewable penetration in the different markets. So in Italy or in Spain, when you got a lot of PV plants, we have a very, very high cannibalization. Plus, there's another very difficult and tricky part, is that the model for cannibalization, of course, is wrong. I mean, it's a statistical model, so you have to put some sort of adjustment to the model to put yourself in a safer situation. So it's having a big impact on solar producer in Italy and Spain, and we expect cannibalization to get higher and higher as more renewables come online. But the real impact of cannibalization is really difficult to estimate. There's no way to hedge it. There's no market for it. So every utility has its own models, and we just believe that at some point cannibalization impact will have an effect also on new investments. So there are two ways out of it. Or the cost of technology keeps going down, so you can sustain even lower and lower prices. Or at some point, someone will have to find other solution to tackle cannibalization, like storages or more flexibility attached to renewable power plants. But currently, we are incorporating our models between 30% and 40% of cannibalization in the next 10 to 7 years. It might be much higher, it might be much lower, depending on how much renewables we will see coming online, what's going to happen to the cost of the technology, and the market itself. I mean, as we heard before, there's a lot of cannibalization in Spain on PV. There's a lot of cannibalization in Sweden for wind. So a lot of the same technology in the same market zone will create a huge impact. We just don't know for how long the market can sustain this with new investments.
And Simone, correct me if I'm wrong, but in the meantime, before with these flexible technologies can have a major impact, do you think producers should take on a bit more of this risk?
I think they will have eventually. There's so much cannibalization risk that a off-taker can take, because at some point there will be too much cannibalization risk in our books. Just it will get more and more expensive to take it, so you will get lower price. Some of these risk can be passed on to corporate PPA, and even that there's a limited potential. And then at some point, I think it's part of the risk that energy producer has to take. It's price risk and cannibalization risk for renewables. So it will have to be the developers and the investors that take on this risk.
I mean, basically, we are now in the discussion about pay it produced and base load, maybe also pay as forecasted. Just to explain that shortly, pay as produced means that the off-taker, PPA off-taker, takes the electricity like it's produced, and baseload is that you have to, as producer, you have to sell really a baseline, which means obviously that when it's the baseline, you are dependent on the exchange prices, on the spot market prices, and you have this cannibalization risk. Is it correct that you think that producers should take the risk to sell baseload? I mean, there are also some examples in the past, I think.
I think they should, and I think they will have to, just because they're not going to be able to find anyone willing to take that risk at some point. So we are taking space produced, we're pricing space produced in Italy, for example. We are not doing it in other countries. We're just doing baseload because we've had too much risk on cannibalization, and so it will have to be the producer that takes the risk.
Yeah, I mean, the point is we still hear quite often that the banks are objecting. I mean, probably this is also country dependent. Helen, have you insights into that? Because I mean, particularly, for example, in Germany, I think it's coming now. Maybe this pay as to sell baseload, but I quite often hear that banks are reluctant to finance projects with such contracts.
Yes. Sorry, as in they're reluctant to finance baseload contracts?
No, basically the banks are reluctant to finance baseload with projects which get the revenue via baseload contracts because that means there's more risk on the producer side. That's what I hear often. So is that still the case, or do you see how that changes from country to country? Will it be that, in more mature markets, I think you have more baseload. Banks are more willing to finance baseload projects, but is that a law, let's say, a sort of natural law that every market will evolve in this direction?
Yes, so that's exactly right. That's my understanding is that the sort of maturity of markets is probably measured by how confident banks are to fund baseload contracts. In general, if you look at sort of where the risk lies between a pay as produced and baseload contract, the off-taker bears the risk for price, liquidity, and profile, and then the producer bears the risk. Well, this is sort of shared volume is shared between producer and off-taker, but in a baseload contract, it's much more complicated because the producer is taking on profile risk, volume risk, and a little bit of price as well. So yes, it does correlate that the banks need to see sort of more sophisticated financial
Do you have an idea why some banks are willing to take this risk or willing to finance such projects and other banks are not? Is it a learning curve at the bank, or is it more a strategic decision of the bank?
I think it's a bit of both, and also kind of confidence in the market. It is a bit self-fulfilling. So the more deals that are done, there's a precedent set. Perhaps similar companies are doing these deals that they have worked with before. So they have established relationships with developers. I think it also depends on the credit risk of the off-taker and the developer themselves. So whether they have a large portfolio to support the baseload. To support the balancing, because if there isn't sufficient capability from the producer side, then I think the bank loses confidence that
I think that is now you have now set very good stage for that we can ask Marc Oman from Google, because I think normally one should think all off-takers are very happy if producers take as many risks as possible. But you, as far as I know, not so Google. I mean, why don't you want that producers shape the production, or let's say you are not so keen that they shape the production, for example, to baseload? Why not?
I think in the case of Google, one of the reasons why we haven't asked PPA sellers to firm and shape the output of an asset into a baseload is that we have set a new target for the company, which is to match our data center consumption in every hour and in every location with carbon-free electricity generation. And so what matters most to us is what is actually happening at the asset level. And so firming and shaping through financial hedging certainly is nice because it means that your OpEx costs are fixed. But our target is to be able to point in every hour to carbon-free generation in that hour. And so firming and shaping a solar output into a baseload block won't change the underlying physical events. So that is the main reason why our PPAs are not firmed and shaped.
I mean, this is going to this 24/7 discussion, which we have already announced, will follow in some minutes. There's one more thing what I'm always curious, let's say, I'm trying to understand, because normally I think that risks will distribute in order to who the most efficient can handle these risks. That's also market economy. I mean, those companies who can most efficiently handle risks, they will can do it the cheapest. And I would say a solar producer has much more difficulties to handle this risk than, for example, an off-taker like Axpo. Isn't that the case, Simone? Why is it really more efficient if the producers takes the baseload risk, the shaping risk?
Well, I think so. If you look at the renewable power plant as an every power plant, you will have to add some flexibility to the power plant, because you are the one operating it that can benefit from different hourly prices in the market. You can store energy when the price is too low. You can sell when the price is very high. If you leave this risk to an off-taker like Axpo, we can manage it with the instruments we have on the market. The instruments we have on the market are limited because we cannot hedge everything. While if you have your own power plant, you can add some flexibility into it. You can do some investment to add flexibility into it. Something we cannot do on the market. Like as I said before, cannibalization is unedgeable in the market. You can proxy hedge it, but it's going to be a wrong hedge anyway, and you're going to always be exposed to some risk. So there's so much we can do on the market, which is less than what the producer can do on his own power plants.
Thank you, Simone. Turning back to Marc, you've given us a little bit of an outline of Google's PPA strategy in terms of it being 24/7 directed. Could you maybe expand on that and also talk about what you're looking for in a solar asset when it comes to organizing a PPA contract?
Sure. Yeah. So I'll just take it in two parts. A couple of words on the 24/7 strategy, and then I'll talk more about what we look for when we contract solar assets. So 24/7 is a company-wide target which we've set out to achieve by the end of this decade, by the end of 2030. By 2030. And so everywhere where Google operates a data center, we are working hard to source carbon-free electricity to match our load in every hour on a grid-by-grid basis. So really think of it as two types of efforts. We are sourcing more wind and solar PPAs because our load is growing, and we're looking to source PPAs everywhere where we have data centers, which is a bit different from what we've historically done when we're only focused on being 100% renewable matched annually and globally, which is we went to the places where wind and sun was the cheapest and the most available. So wind farms in Sweden and solar assets, for example, in some parts of the US. Now, to achieve 24/7, we need to get more wind and more sun PPAs contracted in every jurisdiction where we have a data center. We have about 20 to 30 data centers operating today globally. But the second thing we need to do is to deploy new technologies. And so we're looking both at firm dispatchable carbon-free technologies like geothermal, hydro, as well as advanced nuclear. And we're also investing heavily on things like long-duration energy storage, which I know was mentioned before, because that's an enabler for displacing essentially carbon-free generation towards times when there's no wind and no sun.
I have just a question to because I think also for our audience to understand better the 24/7 approach. Does that mean at the moment you are setting up systems which allow you to monitor when the electricity which you are purchasing is produced? Because I mean, I think at the moment you don't have so much electricity that you are already have an overload and solar electricity at some times. But so at the moment it's more a monitoring thing which you're setting up, which you then can use later?
Absolutely. I would say it's much more than monitoring. we are partnering actively with startups whose core business model is the plumbing infrastructure for carbon-free energy management. Startups like FlexiDAO and EnergyTag, we are partnering with them to ensure that there is a very careful hourly or even 15-minute measurement of the data center consumption, which we have, but matched in real time against the actual asset generation for all of the Google contracted PPAs. We are also on the policy front. We published a white paper a few months ago pushing for something called TEAC, which is time-based energy attribute certificates. The issue we have in the market right now is that when you buy renewable energy, you get something in Europe called a guarantee of origin, but you get it essentially on a monthly basis. And tracking renewable energy production on a monthly granularity does not do justice to valuing the attributes when they're produced at times when there's less energy on the grid. And so we published a white paper arguing that the industry should develop much more granular ways to track wind and solar and carbon-free energy production.
Because I think it's an alternative to what we talked before about is how to, cannibalization on one hand can incentivize other technologies because of because you have this price spread, which maybe will finance storage. And this method is also a way that you have the problem at Google at the end to build other technologies. Simone, what is your view on this timestamping? Is that an alternative to incentivize flexible technologies? Do you see that?
Well, I think for producers, most of the incentives will come from market prices, from hourly market prices. It might be an incentive for the consumer, which will be able actually to certify hour by hour or every 15 minutes that the electricity comes from a renewable source. And in this respect, it might also help the consumers to close corporate PPA with pay-as-produced. So it can be an indirect incentive for the producer itself. But I think most of the real incentives will come from market prices.
Helen, do you see that also in this way?
Yes, I do agree with this. I think the pricing at the moment is justifying a lot of precedent. The precedent for this kind of investment has not been set before, but the prices are now so high that that I think this is the new environment that we're in. We haven't seen a lot of deals come through yet, but I expect that we will in the next coming months.
Mm. And Marc, coming back to that spatial aspect of 24/7, clearly that might suggest now that considering Google has quite a large wind portfolio in Europe, that there might be a premium on solar now and perhaps some deals in the future?
Yes, I wouldn't say there's a premium on solar, but I would say that there are natural synergies for people who want to achieve 24/7 to source a mix of wind and solar. And so we are indeed interested to rebalance our portfolio towards solar, which for historical reasons had been more expensive, but today things are changing quickly. And I think, just briefly on the cannibalization point, I do think that if large energy consumers focus their renewable energy sourcing with a 24/7 mindset, I do think that will somewhat mitigate the cannibalization issues, because I think cannibalization happens when there is a concentration of renewable energy projects in an area where there's not enough load to absorb those electrons. And so one of the nice things about the 24/7 approach is that it forces off-takers like Google to sign PPAs in places where they have load, which by definition avoids the concentration effect, or the wind ghettos, as we describe for wind industry, where there's too much of one type of technology in a given place.
I mean, but at the end, is there really so much? I mean, I'm just wondering whether there's really so much of a difference. On the one hand side, if you go for this cannibalization, let's say incentive way, then the producer has to install the flexibility. If you go your way, at Google, then it's the off-taker who has to take this incentive and invest in flexibility, because at some points you at Google will have to balance out, because to a certain extent you can do that with the mixture of solar and wind, but then at a certain point you also need batteries, I suppose. So it's basically more a strategic decision whether one wants to go the one way or the other.
I mean, I think as Rodolfo was saying, the market incentives should be there, that if there is value in the installation of batteries, which can be in two places. The batteries can be behind the meter of a renewable energy generation asset and displace the times at which energy is being sold back into the market from the renewable energy power plant, so that they don't necessarily follow the solar production curve, but can be shifted out by a few hours. Or if there's value to put a battery behind the meter on the data center or the consumer side. We have done this, for instance, in Belgium, where we're building a battery on site to also provide some flexibility services back to the grid. I think that the market will solve itself. There will be investors that can help build batteries. And I don't think it's necessarily the role, or it's only limited to renewable energy developers to build these batteries. The fact that their costs are coming down will benefit all of the industry. But if there is value in displacing solar curves, then installation of batteries is something that can be an asset class in and of itself, and that doesn't necessarily need to belong to the developer or the investor in the renewable energy power plant or in the off-taker.
And Marc, in addition to batteries, or perhaps even preceding batteries, how do you see the potential of hybridized wind and solar assets? You referred to wind ghettos. I can see, for instance, in Spain, in Aragon or a place like that, which has got heavy wind set up already, that you could retrofit solar into some of these very flat areas that have wind turbines and double or expand your load. Is that something which is on your radar? Would you consider sharing that risk? Is that something which you see playing a role in this 24/7 game?
Yeah, to be honest with you, we haven't looked at too many hybridized assets. I think from our standpoint, as long as these assets are physically connected to the same grid with the same bidding zone, in effect, the assets don't need to be co-located. What matters to us in our carbon-free accounting for 24/7 is the hourly generation and the bidding zone. So in that sense, if there's solar in the south and wind in the north, the fact that the two assets are close or not close to each other is not a particularly relevant feature.
That, in fact, is a great news also for our audience, because I think the least of our project developers, they want to build wind and solar, one has to admit. But I mean, for them, it could be really interesting. Do you have certain conditions which project developers or project or asset owners, solar asset owners have to fulfill in order to make a PPA contract with Google? Or is that a great opportunity for our audience to make contracts with you?
Sure. Yeah, I can just give a very quick summary. So just for context, over the last 12 years, Google has signed about 60 or more power purchase agreements, or PPAs, that cumulatively represent about 7 to 8 gigawatts of installed capacity, mix of wind and solar. We are, constantly looking for new contracts. I would say the tenor for PPAs tend to be somewhere between 10 and 15 years. The most common pricing structure is a sort of a fixed flat price in nominal terms, but we have seen lots of different structures recently, index prices with caps or collars. And in terms of project size, I would say because Google is a large energy consumer, we cannot sign many very small PPAs. It would take too much time. So we look for assets that are 30 to 100 megawatts minimum in size, with solar usually being on the slightly smaller side. And we can contract directly, and sometimes we work with partners that sort of launch RFPs to purchase power.
I mean, I think it's a great panel, because we have a corporate off-taker and we have Axpo as utility off-taker. Simone, how is it with Axpo? Is it also there that you have, let's say, PPA hungry, so that there is more demand for PPAs than there are projects?
No, well, not currently. There are more projects than demand for PPAs, but I think demand will come. It's just taking more time. We also see that the demand for long-term PPAs or corporate PPAs, it clearly depends on market prices. In this current market environment, there's a lot of projects that want to secure a fixed price. So we have a lot of demand from a developer and investor that want to secure a fixed price for us. Corporates, they're not so keen. It takes some real commitment to close a 10 years contract at these market levels. So corporates, they feel the need for sustainability and renewable energy, but also the market price environment has an impact. And this is not the best of the time.
Blake, that is the time we have to conclude and where we also have prepared something.
Certainly, and it's been an interesting discussion, and we haven't even got to the nitty-gritty of energy storage and electrolyzers, other flexibility, but luckily the next segment covers that. But to conclude, we'd like for each of our panelists to finish this sentence. PPA models have a bright future because. Starting with you, Helen.
So I think the current backlash against greenwashing will really boost the market. So we've seen the RE100 initiative in which member companies pledged to source 100% power from renewables. They've tightened their rules on their additionality criteria, and that means that companies are going to have to meet the requirement by actually installing new assets on the grid. So I think, I think that's brilliant news for PPAs.
Okay, and maybe the others, but really just complete the sentence, please, because we are running out of time. So PPA models have a bright future because, and now?
How about you, Marc? Could you go next? PPA models have a bright future because?
Sure, because they are a key ingredient to decarbonizing electricity markets.
Lovely.
Great.
And Simone, the last word?
Yeah, we're going to have a bright future because they're going to be the main actors of the energy transition.
Well, there you have it. In black and white, or perhaps in blue and white. Thank you very much to our panelists for joining us. Very thorough discussion. So much covered, but also a lot left out. It's a very complex and large subject. So thank you for your contributions. Before our next session, you can enjoy a speed networking session or explore the platform. Up next, we have business models of high-tech storage technologies and green hydrogen. See you there.